January 1st, 2026 is not just another date on the calendar, it is the moment the rules of the silver market quietly changed. While most Americans were distracted by headlines and holiday noise, China activated a policy that few on Wall Street wanted to talk about. From that day forward, only 44 state-approved companies were allowed to export refined silver out of China. Not mined or not paper contracts, but refined silver, the kind that actually goes into solar panels, electric vehicles, semiconductors, and data infrastructure. This matters because China controls roughly 60 to 70% of the world refined silver supply, and refined silver is the bottleneck the real economy depends on. When access to that supply is restricted, the impact is immediate and global. In practical terms, more than half of tradable refined silver was removed from international markets overnight. This was not a price move driven by speculation, and it was not a temporary supply hiccup. It was a policy decision by a government that understands resources, power, and leverage. For investors over 35 who already distrust banks, question Wall Street narratives, and have lived through more than one so-called contained crisis, this moment should feel familiar. It is the same pattern seen before the truth emerges quietly. Inventories tighten, spreads widen, and only later does the price react. Whether you already hold physical metals or have been watching from the sidelines, this is the point where waiting for confirmation often means arriving too late. The shift has already happened and the clock is no longer on your side. Most people still believe silver is just another commodity that trades on supply and demand. But that belief is outdated. The numbers tell a different story, and they point to something far more calculated. China currently controls approximately 65% of the world's refined silver supply. Not raw silver, refined. The kind that flows directly into solar panels, electric vehicles, semiconductors, and artificial intelligence infrastructure. At the same time, China consumes over half of global industrial silver output every year. That means the very nation driving demand is also locking down supply. This is no longer a market. It is strategic resource control. We've seen this playbook before. In 2010, China controlled 95% of global rare earths and used export restrictions to push prices up by over 600%. The West took a decade to respond. Now silver is becoming the next battleground. And if you're still thinking like a speculator instead of a survivor, you're already behind. You don't build the future with contracts or promises. You build it with real materials, tangible metal. And this time, the game is not being played in New York or London. It is being written in Beijing. This is not just about silver. It is about who controls tomorrow. In late 2025, something changed, quietly but unmistakably. The Shanghai Futures Exchange reported just 715 metric tons of silver remaining in its vaults, barely enough to meet 2 to 3 months of China's industrial demand. That's the world's largest solar panel manufacturer, its AI server factories, and its electric vehicle build-out all staring at an empty shell. But the problem is not isolated to China. In the United States, COMEX-registered silver inventory has collapsed by over 70% since 2020. What once stood at 346 million ounces now hovers near 127 million. And in London, the story is equally alarming. As of September 2025, the LBMA reported only 155 million ounces of free-float silver, unencumbered, available for delivery. Just 6 weeks of global demand. That's not a self-squeeze. That's a structural crisis. These are not paper problems. These are physical shortages, unfolding across the 3 most critical silver hubs on the planet. For those who thought they would always be able to buy real metal when they needed it, this is your warning. The vaults are not empty yet, but they are emptying fast. And once silver becomes unavailable, price will no longer be your first concern. Availability will be. For years, many Americans over 35 have felt that something in the financial system no longer adds up, and the silver market is now screaming that truth out loud. In late December, the price of physical silver on the Shanghai exchange traded roughly $8 per ounce, higher than futures prices on COMEX, the largest Western paper market. That spread was not a rumor or speculation, it was recorded market data and the widest gap ever observed for the same metal. At the same time, silver entered backwardation, a rare condition where buyers are willing to pay more today than for delivery months from now, which only happens when immediate supply is feared to be unavailable. This is not how healthy commodity markets behave. It is a sign of stress and urgency. Then comes the number Wall Street prefers you ignore. For every single ounce of physical silver that actually exists and can be delivered, more than 300 ounces have been sold through paper contract. That ratio did not matter when nobody wanted the metal. It matters now because industrial users and long-term holders are asking for delivery, not promises. Cash cannot replace silver, and manufacturing and paper claims cannot power energy systems or electronics. This is the moment when trust quietly breaks. The market is telling you that physical metal matters again, and those who understand this are no longer asking whether something is wrong, but how soon the rest of the world will realize it too. In December 2025, something quietly terrifying happened. Over 4 trading days, more than 60% of registered silver inventory on the COMEX was claimed for physical delivery. The exchange called it a vault drain crisis. But the deeper concern is this. What happens when an industrial user demands real silver, not cash, and the exchange cannot deliver? This is not theoretical. Futures contracts represent claims on physical metal. But in today's market, for every 1 ounce of actual silver, over 300 paper claims exist. Imagine a solar panel factory in China or a semiconductor plant in Texas standing for delivery on 20 million ounces they need for production. The delivery window arrives, and the exchange responds with a notice. Force majeure. Settlement in cash only. But you cannot fabricate circuit boards with dollars. You cannot power a clean grid with digital IOUs. At that moment, the price discovery mechanism collapses. Faith in the system breaks, because the illusion that silver is abundant unravels when the metal itself cannot be sourced. This is not fear-mongering. It is a mathematical failure of a fractional reserve model applied to physical assets. And when it breaks, it will not be a headline. It will be a supply shock. Sudden, silent, and real. In 2010, China controlled 95% of the global rare earth supply. When they restricted exports, prices surged over 600% within just 2 years. It wasn't a supply issue. It was leverage, strategic, calculated, and now they are doing it again, but this time with silver. On January 1st, 2026, China imposed strict export licensing, narrowing global access to refined silver down to just 44 government-approved companies. The timing is no accident. China consumes over half of the world's industrial silver, and silver today is not just about jewelry or coin. It is the lifeblood of solar panels, electric vehicles, semiconductors, and artificial intelligence infrastructure. Unlike rare earths, silver spans both the energy transition and the digital revolution. That makes it twice as irreplaceable. And here's the wake-up call. Silver stockpiles are collapsing. Shanghai's warehouses dropped 86% from their peak. London's vaults are down 50%. COMEX inventory has shrunk by 70% since 2020. This is not theory. This is not a chart pattern. This is strategic resource control unfolding in real time. If you remember what rare earths did to global supply chains, then you already know how this story ends. The question is whether you are holding an asset or holding an excuse. Most people think rising prices will naturally bring more supply. But when it comes to silver, that belief collapses under scrutiny. Around 75 to 80% of global silver production doesn't come from primary silver mines. It comes as a byproduct from mining copper, lead, zinc, and gold. That means even if silver shoots to $100 an ounce, it doesn't magically unlock more supply. A copper mine will not increase production just because silver becomes more valuable. Their decisions revolve around copper economics, not silver. And if you're thinking, why not just open new silver mines, the answer is sobering. From discovery to production, a new mine takes 7 to 10 years to become operational, assuming ideal conditions. But in today's world of rising regulation and permitting delays, it could take longer. This is not a flexible market. It is structurally inelastic. If you are sitting in cash waiting for a pullback, understand what that really means. The silver you are hoping to buy later might not be available at any price. Because this is not just another commodity. This is a resource bottleneck that money alone can't solve. And those who understand that early are the ones who will not be caught outside when the doors finally close. In early January 2026, a quiet tension grips the silver market. For those who have watched cycles come and go, the next move may no longer be about speculation but survival. Conservative analysts place silver between $45 and $65 an ounce this year, assuming China resumes normal exports, demand softens, and recycling expands. That's the soft landing. But in the real world, exports remain tightly controlled, deficits persist, and global inventories sit near multi-decade lows. Under those conditions, the baseline becomes $70 to $90. It gets more serious if force majeure enters the picture, when exchanges simply cannot deliver physical metal. At that point, industrial buyers scramble, the Federal Reserve may return to bond buying, and prices could surge to the 100 to 125 range. And if the system breaks, if China refuses to export, delivery fails, and a monetary shock ripples through the West, we are staring down triple digits fast. That is the $125 to $150 scenario. These are not hypotheticals. They are data-driven possibilities built on depleted inventories, state-controlled supply, and a 300 to 1 paper-to-physical ratio. If you are sitting on the sidelines, the question is not whether silver will move. It's whether you will still be able to get it when it does. Back in December, silver surged to $84 an ounce before the exchange stepped in and raised margin requirements. That alone should have raised questions. But here's the part most people overlook. What if the real risk is not that silver goes down, but that it goes somewhere you cannot chase it? Right now, silver trades around $72. Sure, maybe it drops to $50 if everything resolves smoothly. That is a 30% downside. Manageable. But if a force majeure event hits and industrial users cannot get physical delivery, the upside is not theoretical. It is mechanical. We are talking about a move to $100 or even $125 per ounce based on the same delivery failures we already saw signs of in December, when 60% of COMEX registered inventory was claimed in just 4 trading days. That is a potential gain of over 300%. For anyone sitting on the sidelines, waiting for a dip or a pullback, the math is saying something very different. This is not about timing the bottom. It is about asymmetric risk, the kind of setup that rarely happens and never stays open for long. Downside risk is visible. Upside risk is concealed. And that is exactly why it cannot be ignored. For years, many of us sensed something was off. The headlines never matched the data, and the calm on Wall Street felt manufactured. Now the numbers confirm it. Over the past 5 years, the global silver market has faced a cumulative shortfall of 800 million ounces. This is not a forecast. It is a ledger entry. During that time, registered silver inventories at COMEX dropped by over 70%. The London Bullion Market Association saw its vaults depleted by 50% from their pandemic peak. Shanghai's inventories collapsed by 86%, leaving less than 90 days of industrial supply. Meanwhile, China has quietly taken control of 65% of the world's refined silver. This is not the typical commodity cycle. This is a structural breakdown. Whether you already hold physical metal or have been waiting for the right signal, the message is now unmistakable. The system that priced silver as just another speculative asset has failed. Silver is not cheap. It is mispriced. This is no longer about trends or opinions. This is math, the kind that does not ask for permission. And when math collides with scarcity, history shows us what happens next. Those who wait for confirmation rarely get a second chance.